the market reaching down in short-term low. And then here's news. And this is my Venom model. The way it works is first you have to know what you're looking for. In this case, higher prices. Why? Because it's been dropped all day long. And here is your sell side liquidity. And they drop it down through the low. But they do it with a SIBI. Sell side imbalance, buy side inefficiency. Then they do a few candles down here. And then they send it ripping right back up. And that single candle going back above that low is a BISI. So we have a strong one-sided candle going down to take the liquidity, a couple candles left underneath that low to absorb all the sell stops for accumulation purposes, and then they displace it higher. This is the two fangs that make up that model I call Venom. And they're injecting the venom into these sell stops. So fang 1, fang 2, then leaves. Okay? I'm looking for a entry before this candle's high is taken out. I want to be buying. Now, there's two ways you can do it. You can do it as a buy on a stop. So buy stop, this candlestick's high. You can buy it that way. Or if you're trying to keep a tighter stop loss, you can be buying at this candlestick's open or less. Okay, so it's a power 3 type of entry model. So opening price comes in at 19,174 even. So you can put a limit order in. As soon as this candlestick closes and you open a new one, the limit order goes in at this candlestick's opening price at 19,174.00. You put the limit order in, and in this candlestick here, you'll see that I got filled there, and you can see that there. See that? Look real close right in here. I'll try to zoom the video in. There is that little caret symbol that tells you where the actual fill is, and there's the numerical value. Now, the stop loss on that trade is this BISI. And if you look at where I have the fib, see the lower anchored point and the higher anchor point. Those two reference points, and that's what this level is here. Consequent encroachment of that. Stop loss has to be just below that. Why? Because this Venom model is a balanced price range, and it should not come back down here. If it does, it's not a Venom, and it's probably going to be a wrong trade. Okay, I'm not going to be profitable if it goes down to consequent encroachment or less than. So I can put a stop loss just below that and feel confident that it's okay. And the market daily dies around in here and then sends it higher. And we have this consolidation in here, and they pump it right up into new week opening gap for this week. Lots of price action delivery in here. Consequent encroachment. Look at the bodies. That's so beautiful. So it drops back down, takes out the sell side here, and gravitates right back up to the new week opening gap low. This run here to there, that small little scalp right there, that could be your whole model. That could be just what you're looking for. See this wick? Consequent encroachment of this wick. It's a discount wick when price goes above it. If you know it's likely to draw back into the new week opening gap, as soon as we break above it, the next candle we open, trade down to it there, boom, there you go. There's your entry. And this portion should stay open as what? A breakaway gap. And it rallies right back up into, they take the short-term buy side here and back into the new week opening gap low.